In the rubble of the greatest financial collapse in modern history, when Wall Street was a graveyard of broken dreams and lost fortunes, two professors at Columbia University sat down to write a book. It wasn't a book about getting rich quick. It was a book that aimed to turn the speculative gambling of the 1920s into a disciplined, logical profession. That book was Security Analysis. Written in 1934 by Benjamin Graham and David Dodd, this 700-page beast became the literal Bible of value investing. It's the book that trained Warren Buffett, and it's the intellectual foundation for virtually every successful value investor of the last century. But what did this book, written with the wounds of the Great Depression still fresh, actually teach? How did it create a complete paradigm shift in how we think about money? Today, we are digging deep into the original 1934 classic. Stick with me, because understanding the core principles from this masterpiece is like getting a masterclass from the founding fathers of investing. The final lesson we'll cover is Graham's single most important distinction, one that can protect you from the market's biggest dangers. Let's begin. Part 1. The revolutionary idea, intrinsic value. Before security analysis, the stock market was largely a game of tips, rumors, and guessing which way the herd was running. Graham and Dodd introduced a radical idea that every single security, every stock, every bond has an intrinsic value. This intrinsic value is independent of its fluctuating market price. It's the real, underlying worth of the business. It's what a rational, informed businessman would pay for the entire enterprise. The market price is what the security is selling for today, driven by fear, greed, and popular opinion. The intrinsic value is what the security is actually worth. The entire job of the security analyst, Graham argued, is to determine that intrinsic value. As Graham and Dodd wrote, the essential point is that security analysis does not seek to determine how much a security is worth in the abstract. It seeks to determine a prudent value for the security, which can be compared with its current price. This simple but profound distinction, price versus value, is the bedrock of everything that follows. For the first time, investing was no longer about predicting the market's mood, it was about calculating a company's worth. Part 2. The new professional, the security analyst. Graham and Dodd weren't just writing for casual investors, they were defining a new profession, the security analyst. What does an analyst do? They are a financial detective. They are a skeptic. They don't listen to hype from management or experts on Wall Street. They do their own exhaustive, independent research. Their process is methodical and disciplined. They analyze the past. The analyst scrutinizes a company's financial statements over many years. Graham recommended 5 to 10 years to understand its stability and true earning power, not just a single good year. They focus on facts, not forecasts. They are concerned with what is, not what might be. The goal is not to predict future growth with precision, but to understand the value of the assets and earnings as they exist today. They are conservative. The analyst always assumes the worst. They look at liquidation value. What would the company's assets be worth if it had to be sold off tomorrow? This creates a floor for their valuation. This approach transformed investing from a speculative art into a rigorous, evidence-based field. Part 3. The ultimate protection, the margin of safety. This is the concept that Ben Graham is most famous for, and it's the direct result of the price versus value idea. If your analysis tells you a company is worth $100 per share, its intrinsic value, you don't buy it at 98. You wait. You wait until the market, in its infinite foolishness, offers it to you for $60 or $50 or even less. That massive discount, that gap between the value and the price you pay, is your margin of safety. Why is this so crucial? It protects you from your own errors. Your valuation will never be perfect. The margin of safety is your buffer for miscalculations. It protects you from bad luck. The future is unknowable. A great company can face unexpected headwinds. The margin of safety absorbs these shocks. It's the true source of returns. As Graham and Dodd famously stated, the margin of safety is always dependent on the price paid. For any security, it will be large at one price, small at another, and non-existent at some higher price. High returns don't come from buying risky, speculative assets. They come from buying wonderful assets at a price so low that the risk of permanent loss is minimized. Part 4. The prudent order of operations. Bonds first. Remember, this book was written during the Great Depression. Capital preservation was everything. Because of this, Graham and Dodd dedicate a huge portion of the book to analyzing bonds and preferred stocks before they even touch common stocks. Their message was clear. You have no business buying the riskiest part of a company, its stock, until you've mastered how to analyze its safest parts, its debt. They laid out incredibly strict quantitative standards for what constituted an investment-grade bond. Sufficient earnings coverage. The company had to be earning its interest payments many times over for many years. Asset value. The value of the company's assets had to be significantly greater than the total amount of its debt. Only after a company's debt was deemed safe could an analyst even begin to consider looking at its stock. This safety-first hierarchy is a lost art today, but is central to the book's philosophy. The enduring distinction: investment versus speculation. And this brings us to the final, most important lesson from the 1934 edition of Security Analyst. Graham's entire life's work was to draw a bright and clear line between two fundamentally different activities. He defined it with crystal clarity. An investment operation is one that, upon thorough analysis, promises safety of principal and a satisfactory return. Operations not meeting these requirements are speculative. Let's break that down. An investment requires three things: thorough analysis, you've done the deep quantitative work of a security analyst; safety of principal, your margin of safety protects your initial capital from permanent loss; and a satisfactory return. The return doesn't have to be spectacular, but it must be adequate for the risk taken. Anything that does not meet all three of these characteristics is, by definition, speculation. Buying a hot tech stock based on a story? Speculation. Buying a stock because the price is going up? Speculation. Buying without doing the hard work of valuation? Speculation. The ultimate lesson of security analysis is to know which game you are playing. There is a place for speculation, but you must never confuse it with investing. The path to financial ruin is paved by speculators who believe they are investors.
The world has changed immensely since 1934, but the principles of value, prudence, and temperament laid out in this book have not. They are timeless because human nature, the fear and greed that drives market cycles, is timeless. Security Analyst is more than a book. It's a manual for rational thinking in an irrational world. If this deep dive into a classic was valuable to you, please hit that like button and subscribe for more content that goes beyond the surface. I'm really curious. What's the most powerful investing principle you live by? Let me know in the comments below. Thanks for watching, and invest wisely.